Okay, let's get going. This is Steve Lentz. Welcome to this presentation here, one of our normal Monday presentations that we make available to anyone and everyone that can make it. I appreciate you joining us here today. And I'm just getting used to the new format that we have. This is just real good stuff. I'm very pleased with how this is working so far. Folks, today we are going to discuss Bollinger Bands yet again. I know this is part 3 for me. I know our presentations have been broken up a little bit with other speakers. But I will be in New York this coming weekend at the Traders Expo, and I'm going to present this material. And for those of you that have joined us for part 1 and 2, this is going to involve a further refinement in the way we explain Bollinger Bands, and then also in the actual trading system that we present using credit spreads. And so I think you'll find that this is kind of taking us further down the road, and especially if you haven't really studied Standard Deviation and Bollinger Bands and that much, I hope that this will provide some good insight as a noun, not inciting you to anger as in a verb. Okay, let's see here. We're clicking things and nothing's happening. Okay, here we go. All right, here's the outline. We're going to answer 3 questions here today. What is a standard deviation? Now, some of you are going, oh, brother, I took statistics in college, and I did too. But if you're going to use a Bollinger Band or any kind of volatility-based indicator, it helps to have just a refresher so that when you make a decision based on that, you kind of can feel the indicator in your bones a little more, and that you can make the decision with greater conviction. And I apologize. I have to kind of take a small 1-second break. It's not a good idea to drink a carbonated beverage just before you go on and going to present to a bunch of people where the carbonation is kicking in, if you know what I mean. So forgive me there. All right, number 2, what are Bollinger Bands and what trading signals can come from them? We'll answer that question. And then what is a good credit spread system to use with Bollinger Bands? We're going to explore that. We're going to go through all 3 of these and kind of a progression, and I hope you benefit from this somehow. Okay, I'm clicking again. I have to keep going down there. There we go. Perfect. Let's begin with standard deviation. This is kind of the building block of understanding this indicator. All right, a standard deviation. Oh, you know what? My little animation things aren't going to work. I just realized that. I had this cool progression of when I would have a chart and I would click and then this thing would fly around and land and all that kind of stuff. But that's not going to happen today. All right, so we got to work through that. I'm going to have to use more slides or something to kind of do a Charlie Chaplin-esque type of an effect. All right, so I'm just going to use this little highlighter. Here's what it is, standard deviation. It's basically, we're going to measure how spread out numbers are. That's what a standard deviation is. If the standard deviation is higher, well, the numbers are really spread out. If the standard deviation is small, that means that the numbers or the population that you're looking at is very narrow. Now today, I'm going to use an example from something other than price just to get this notion of standard deviation into our bones, okay? Because if we're going to trade this way, we got to kind of have a feel for what greater conviction to hit that order button. All right, here's the symbol for sigma. Those of you from fraternities, you kind of know what that is, and you may not want to revisit. That might bring back bad memories or good memories. It just depends. All right, so that's a sigma. When we say 1 sigma, 2 sigma, we're saying 1 standard deviation, 2 standard deviation. So some people just say sigma. All right, and it depends what industry or in certain areas of finance, they always say sigma. Gosh, there was someone that was using Gaussian as the name of it because it was, after a guy that really, teed off on this in statistics. Okay, now the formula for standard deviation is this. That's the square root of the variance. All right, so easy, right? Well, what is the variance? What is the variance? It's the square root of the variance. What is the variance? All right, it's the average of the squared differences from the mean. Now, I'm going to walk you through this using a small population of canines, and we're going to explore why in the world we even use squares and square roots. Why not just take the average differences from the mean? Okay, you see that? The average difference. Why don't we just do this? Let me just cross this out. The average of the differences from the mean. Why don't we just do that? Well, we're going to explore that. You'll understand that in just a second. All right, so to calculate the variance, first we have to find out the mean. All right, and then for each of the numbers, all right, for each of the numbers, for each of the canines we're going to look at, or for each of the prices we're going to look at, all right, we have to determine the difference. And then we square that difference. See that? We find the difference, subtract the mean, from the, and then we square that result. And then we work out the average of those squared differences. All right, so I know your head's spinning. I know mine was when I got into this. It was like, okay, I'm going to explain this in a real good way so that everyone understands Bollinger Bands from their bones. All right, here we go. So I have to click again. Where am I? There we go. All right, let's take a look at some canines here. Let's just say, and this comes from mathisfun.com. All right, you know what they say, and I love to repeat this. All work and no plagiarism makes for poor presentations. All right, so when someone has a great example and they lay it out, and this is the beauty of online learning today, is there's some awesome teachers out there that are making things that used to be very complex, kind of easy to know. All right, here we go. You take 5 canines, and we want to find out the deviations from them. And so let's just measure each one from their shoulder to the ground. And if we did that, all right, if we did that, we're going to find out that this big dog here is 206 millimeters from the ground at the shoulder. This one here is at 76. This little guy here, all right, no. All right, no. These are the deviations. Hello. You know, where's my little eraser? I don't have an eraser. Excuse me. Let's come up here. The height at the shoulders. 600 millimeters for this big guy. All right, for this little whippet dog here, 470. For this little Dachshund thing, 170 millimeters at the shoulder. Okay, for the terrier there, 430. And then for the little, what is that? That's not a boxer. That's it's another terrier type thing, a Boston Terrier, I think. 300 millimeters at the shoulder. Now here, we're going to find out what's the standard deviation on these measurements. And then we're going to relate it to price. But if you follow me here, this will make so much more sense. So we have 5 dogs, and we're going to find out the mean, the variance, and then the standard deviation using this little example. So the first step is to find the mean, and that's simply the average of all these heights. So we take that 600 for the big guy, 470 for the whippet, the Dachshund's at 170, the Terrier's at 430, and the Boston guy's at 300. It adds up to this. You get the average of 394. All right, that's the average. That's the mean. 394 is the mean. Okay, now, we calculate each dog's difference from the mean. Each dog's difference from the mean. So we have this 394 number here. Let me change colors and circle that 394 because that's the big number we got to really remember. Okay, so the difference from 600 to 394 is this 206 figure. The 470 is that's only 76 away from the mean, from the average. The little Dachshund guy is underneath by 224. You see that? The Terrier is right, almost there, right at 36. And this Boston Terrier guy is just underneath by about 94 millimeters. So these are the variances from the mean for each of the dogs. Now what do we do? Okay, we take each of these differences and square each of them. So that means 206 times 206. Okay, 76 times, and these are going to be big numbers. If you have a negative number, what does that mean? Negative times a negative is a positive. Okay, and we're going to add all these up, and look at this. We're going to get 42,000, 5,000, 50,000, 1,300. These are some big, big numbers here, and we're going to take the average of all these really big numbers. We took each one of these differences and squared them. So look at this. You add them all up, it's 108,000, and we divide by 5. The average is 21,704, and that's labeled the variance. Okay, and all we do is take the square root of that variance, got it? And then, ta-da, it's the standard deviation. That's the standard deviation. See that? Okay, so let's walk through a few questions here, because I know you're going, why are we going through all this? Why don't we just take the average of the means? All right, well, this information is really valuable. First of all, let me just say that. It's really valuable because now, if we knew that that is the standard deviation, watch this, we can kind of come into this chart, and we have the means at the green line, and then we have 147 up, we have 147 down, and we can see kind of a range here where most of the dogs are going to fall. And we can see that the big guy is clearly outside of that one standard deviation. We see that the small guy is clearly underneath by quite a bit, and the other three are kind of right in the heart of that first standard deviation. And so when you have and this really helps us understand a lot of things in the world of statistics and psychology. This is a big deal, is to understand where all this kind of stuff comes from. So we're going to take this, though, and relate it to price. But first, let's just walk through a few little problems here. Why are we going to do this squaring and square root business? That's kind of what I wanted to know. When I got into this, it was like, well, I kind of would prefer to have a better understanding without having to walk through all this. But this will really line it up for us. We can't just simply add up the differences from the mean, all right, because then the positives and the negatives would cancel out each other, and you'd have a number that really isn't going to, if we had a population of 4 and 4, 4 and 4, 2 4s on each side, we end up with a pretty, obviously 0. Okay, if you just simply added up the differences, that's not really telling us relatively how volatile things are. But what about taking an average of the absolute values? This is going to get us a bit closer. We just take the absolute value and take the averages of those, or basically we're taking an average of the mean, or excuse me, an average of the differences. An average of the differences gives us 4. Okay, well, that's fine, except for what if you have something like this up here? See that? What if we had that? If we just simply took an average of the differences, we're going to end up with 4. But look, these are really wide apart. There's a big variance here. We can't just add these up. 7 plus 1 plus -6 plus -2, well, that would give us 0. No, instead we have to walk through this process of doing the square and square root thing. So, and here's why. So let's try let's just take these examples. One with the 4s, one with the, big variance here. Okay, now watch this. We're going to take each one of these and square them. Bing, 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 bing. Okay, and we get our standard deviation is 4. When we take the average, when we add all these up, take, what's that going to be? 4, 16 plus 16 plus 16 plus 16 is 64. Okay, and then we take the 64 divided by 4. We take the, well, that's 16. We're going to get 16 divided by 4 is 4. Watch this over here. When you square root, when you square a number, you're going to get a real fat number. So this plus 7, when you square it, you're going to get 49. That's a big number. This little 1 down here is a small number. So now we're really teeing off on the variances here, so that when you take the square root of each of these and add them up, you get 90. You walk through this, now we have 4.74. Now we're getting somewhere. Now the deviation that we're reporting is something that's going to vary according to how much how spread apart these numbers are. See that? And that's why we do the squaring part of it. Okay, we're basically taking an average of the variances, but we're doing the square rooting to then accentuate those that are really far away, and they're going to have an impact on that number that we're going to report. So anyway, I think this is just hopefully you understand a little bit why we have to walk through this process. Let me now take you through an example related to price. Let's take a slice of price chart, and you know, this X was going to be dramatically added after I clicked the button and then it went in there. So pretend it's not there, all right? Pretend it's not there. That was one of my dramatic things coming in. And I want you just to notice that we have our 20 moving average, all right? And then for each of the closes, we're recording the difference from the moving average. And intuitively, we think that that's the way you're going to, gauge deviations, right? Is how far away these closing prices are from the moving average. And you know what? That is not what we're doing here. Okay, cue the big X, comes in. That's not what we're doing. Instead, we begin with our moving average. Let's say we wanted to determine the standard deviation as of October 10th right here. Right there, October 10th. I'm going to walk you through how we do this, because then the whole notion of a standard deviation is going to have a little more meaning. All right? And then when we build a trading system off of that, you'll have a better feel for this. We start out with the current mean over the last 20 days. And it's right there at, say, 845 and change. Let me change colors, okay. We take the difference between this moving average and the close, and we go to each one of those closes for the last 20 days. You see that? Okay. These are the differences between today's mean and today's price, yesterday's price, the price 3 days ago, 4 days ago, 5 days ago, 6, all the way back to 20 days here. All right? And these are the differences that I laid out here. And yes, I did painstakingly go through this and look in my Metastock chart and write these down and put them in a spreadsheet, as I'm going to show you here. So I'm going to take 18.6, 17.4, bam, there it is. Look at this, 17.4. 18.6, 6.9. I'm going to walk you through this spreadsheet because I'm going to show you how we derive this thing. Here are the dates, the closing prices for each. This is in the Russell. I'm taking a running 20-day average for each of the days. So on the 17th here, that was the 20-day average. 20-day average keeps changing, and we come down here to October 10th. That is the day that we're going to calculate what the standard deviation is on that day. Now here's what you do. We're going to take that mean right there. And I'm just going to isolate that because that's the one we're looking at. We then take the difference between the closing price and the mean. Okay? And that gives us the deviation level here. See that? And so over here, I'm going to take the closing price and the mean, okay, and then that's the difference. Okay, closing price and that day's mean, that gives us the difference. Got it? So for each of the last 20 days, I have their difference levels from today's mean. We then square each one of these numbers. All right, so these numbers are really big, right? Some of them are real tiny because, the price almost landed right on the mean right here. Not a big deal. Okay, we're going to add all these numbers up, and we get this big number. We take the average of all of these, and we get this number here. We take the square root of that, and ta-da! That's our standard deviation. See that? Okay, now in an Excel spreadsheet, it takes a bit of work, and it took me a lot of work just to get one line done. Okay, and I'm sure there's a way I could do it so it doesn't, it just kind of it'll take a little bit of an extra expertise level to get it flowing in an Excel spreadsheet. But what I'm doing for you here is I'm going to go to my Metastock program, and they have a function here called Standard Deviation. And you could see on October 10th right here, you could see where it is. It actually came out to exactly 10.33. I was very pleased to find that out after walking through Excel, dialing it up in my Metastock, and seeing it land right on the money. I was real happy with that, of course. But I wanted to walk you through that so you can see. So what do we do with this information? What do we do with this information? If you look back at the last 20 days, the standard deviation is at 10.3. Now what we're going to do then is build our Bollinger Band around this. Here we go. You ready? What's a Bollinger Band? There it is. That's your Bollinger Band. You take the current moving average. We're going to add 10.3 to it to get an upper Bollinger Band. We're going to reduce that number by 10.33 to get the lower band. And you can see price right now is outside of the bands as they are. All right? So what you'll have then is as price gets farther and farther away from our average, okay, you can see that the bands will begin to widen. The standard deviation will grow, and as the deviation grows, the bands widen. When price comes down closer to the mean, and if it stays closer to the mean for a few days, you're going to eventually start seeing that the bands start getting narrower towards each other. The deviation will get less and less. It will get narrower. And so that's kind of how it goes. The bands get wider and narrower, not wider and narrower, as price deviates from the mean, or the 20-day average in this case, more and more. Okay, so what's my next slide here? All right, so that's what a Bollinger Band. John Bollinger thought of this thing back in the late 70s, early 80s, when he really published some stuff on it and recently trademarked it and everything. Ding, there it is. All right, we're calling these volatility bands. We could call them deviation bands as well, but they're placed above and below a certain moving average, and you can change that. I'll show you how in just a second. And I just showed you volatility is based on the standard deviation. They automatically widen and they get narrower, etc. Now in OptionVue, and every program has a place where you can come and change it. You could change the look-back periods, and you could change the number of deviation, or how many standard deviations you want those bands to be set at. Now I just showed you a 1 standard deviation band. Okay, these are all set 1 standard deviation away from the 20-day moving average. Quite often, what you'll find is the default setting is always 2 standard deviations, and that is because most traders and a lot of educators, they're really looking at areas where price is going to make a top or a bottom. All right, and when you set it out at 2 standard deviations, when price clicks it, or tips it, there's a pretty good probability it's going to slow down or even reverse perhaps. All right, now what's my next slide here? So now what we're going to do, I'm going to show you, we're going to go to a 20-1 here in a sec. First, let me show you what a 2 standard deviation looks like, and that's I like to paint them in red. And boy, you can see when these bands can get pretty narrow, it doesn't take much for price to pop over even that 2 standard deviation range there. And one trading signal comes off of the 2 standard deviation line, on the 2 standard deviation line, and it's called a Bollinger Bounce. You can certainly construct trading systems based upon this, and even options trading approaches, but it works like this. Price can goes beyond the upper 2 standard deviation line and then close inside like this one. It closed outside, closed inside. That was a signal to go short. Good probability it was going to go and touch the mean here. Quite often, though, it will happen, close above, close below, then it goes to the mean right here. All right, quite often it'll happen on the second go around, and Arthur Merrill really teed off on this in his M&W patterns, and you can look that up and dive in. Now, what we're going to do is construct more of a trend following approach rather than a market reversal or trading premium based upon likelihood that a market is overextended in one direction. And at Discover Options, we have a number of approaches that do that. Very high probability approaches using divergences and the like, and we talk about that in our Level 2 class and also our futures class, is finding market tops and bottoms using divergences and things like this. But what I want to talk about today is a system based upon trend following. Trend following, and in particular coming out with a credit spread approach using the Bollinger Band breakouts in terms of trend following. And so what we're going to do is look at the green line, which is the 1 standard deviation line, and that is price can touch or close beyond, and we're going to say close, beyond the upper or lower line, and that then signals a trend. And again, we're using green, it's the 1 standard deviation that we just calculated here. Okay? All right, here's the premise. When price closes outside of a 1 standard deviation band for the first time, it signals an actionable trend, a credit spread positioned with the short strike just outside the opposite band, either the 1 or the 2, is likely to make money by the time an opposite trend is established. Now, those of you that were in the class last time I discussed this, you'll know that I position the credit spreads beyond this 2 standard deviation line. For example, well, let's just talk about for this. Let's just talk about this first part here, right here. I'm circling the part I want to address first. Okay. Let's talk about trend, and then we're going to get to credit spreads in a sec. When price closes outside a 1 standard deviation band, ding, right here, it signals an actionable trend. Now think about this. Here is the 1 standard deviation level. Price closed outside of a very reasonable boundary, a line in the sand, where if you're inside the boundary, prices can be choppy, but once you go outside, this market is making a pretty clear statement. It's saying outside the 1 standard deviation, it's saying basically, look, things have changed. That over the last 20 days, things have changed. Price is now moving at a greater pace, and it's moving upward in this case. And indeed, price did continue up. It didn't close below the lower band. That would have signaled a downtrend. It scraped on it, didn't close beneath it, kept going up, and didn't close underneath it until it got right here. See that? And then that was a downtrend. That was signaling, hey, price is now going the other way. Price closed a standard deviation away on the downside, and it scraped along the upper border, but then continued down. See that? So, how to trade this basically? How to trade this? So, when you have a signal like this where it closes outside the band, let me see, what's my next slide here? Let me just go there. All right. Here's the thing. Let's say that you were going to trade this signal here. Okay, and let me, I don't know if there's an eraser. What is that missing? No. We're good. Look, you can either position your short strike outside of the green line or the red. Last time we came further out and we positioned our short strike at the first strike outside the red line. And after doing some testing and work, I came to the conclusion that we really want to look at coming closer to the market, going to the green line, and getting more premium, trying to aim for more returns. So we're going to go closer to the market and sell premium at the first strike outside that 1 standard deviation line. And later I'm going to show you the comparison of the 2 systems. Okay. Now, So we're going to come closer in, and also last time I said we're going to sell premium outside the red line here, and we're just going to let the market take it and expire that out. And so if we sell this premium for a credit of, say, $2, we're just going to go ahead and let it go, and we're going to get all our $2 so long as the market doesn't come down. And well, here it would have actually triggered right there. We would have been out at that point. Over here at the one I'm pointing to now. Okay, but what I'm saying here now, instead of just letting it expire, what we're going to do is I'm going to do a yield grab of 2/3. Meaning that if I sell this thing for $2, okay, I'm going to try and buy it back for roughly 2/3 of that. What, about a $1.25, $1.30, something like that, when I can, and I'm going to leave the rest of that on the table there. Something, you know, I'm going to leave the other third on the table. I'm going to just do a yield grab. So when 2/3 my credit is available for profit, boom, we go for it. So here are the trading rules. Let me walk you through this a bit. Similar to last time, with some big differences. Okay, since it closed below the 1 standard, this is in the case of a bullish spread, closes below the 1 standard deviation band. Okay, it now closes for the first time above the 1 standard deviation band, right? So I just showed that to you. Price closes above the band since it closed beneath it. And we're doing the 1 standard deviation. On the close, sell a put credit spread position just outside the 1 standard deviation band on the other side. We're going to do premium in the first month with over 21 days. And we want at least 5% yield, which isn't too much of a problem since we're closer to the market now. How do we exit? All right, when the market reverses and closes below the lower 1 standard deviation band, or we're going to do the buying back at a 1/3 of the credit or better. Real simple. We're going to do that yield grab, and then we just invert this for the bearish credit spreads. So let me walk you through a few examples if I can. Here, let's go over here on the left, okay, and we're going to go to March 13th right here. March 13th. This bar right here closes above the upper band. Previously, we were underneath that. Now it closes above the upper band, and we could sell premium either here just underneath the 804 mark here, or underneath the 792 mark here. So in the previous system, we would have sold the 790 put. Over here, we're going to sell the 800 put instead right here. Okay? What happens then? The market chops around, and eventually, boom, on the 5th of April, it closes underneath that lower band, and then boom, we're going to get out. We're going to get out of this spread and open up a new one by selling premium outside of this band right here. See that? So it could be it could be periods where you're in the market all the time seemingly, but you're going to see that this trade here made money and we were actually out with our yield grab several days before we were triggered back in. All right, so let's just walk through this process here. Let's go again to March 13th. We're going to sell that 800 premium. There we go. Coming down here to the 800 premium. The first month with over 21 days is April. We sell that 800 for $12.80. We buy that for $10.70. I think I might have had slippage going on here, if I'm not mistaken, too, kicking in here. And when we analyze that, those of you familiar with OptionVue, there it is. There's our profit at expiration. But if things work out, we have no intention of letting it go there. We're going to get out as soon as we have 2/3 available or so. Okay, so we're going to put that on. And look, as time goes on, we're continually making money. If the trend stays in our favor, well, we have time and trend working for us. Now we're going to see what happened. Basically, is that price chopped around for 2-3 weeks, and we ended up getting out of this thing with a little bit of a loss. Let me show you what happened. Okay, there it is. Price wobbled around and came back, and we got out on April 5th with a small loss. Much smaller than what it is we were trying to make. And so you're going, wow, how could you possibly show an example of one where you lost money? Well, losses happen. All right, and I want to make sure you can kind of get a feel for this. We certainly have a lot of winners, but I want you to get a feel for what a loser is. A typical loser should be less than what our typical win is going to be, and I'll show you statistically how that panned out. Let's go now to what happens then. Remember, we put this thing on the 13th right here. We sold this premium here. Okay? Price came down to this level, but it took a while to do that. We ended up losing a little bit of money. We closed this position out and open up this one. We're going to sell premium just outside that 837 mark at about the 840. We're going to sell some 840 calls. And as you can see, the market went down, and we actually did our yield grab. Let me show you how that played out then. So we're going to sell. We're going to close this trade out, come up here to the 840 in the first month with over 21 days. That's in May. And we put this on, and as soon as we can get a third of this credit or better, and I kind of ballpark this walking forward, here we are on April 5th. The market did go down, and time did, go away on us, and so we ended up taking off the trade when we had about 2/3 available right there. Take it off. We had a third left, but there's 25 days left in the life of this option, and if the market reverses, we're going to be kicking ourselves, letting us let the big fat profit go away just because we got a little greedy there. So we're going to apply some yield grab principles here and see how this performs. All right, so let's go here. Let's continue to here. Oh, and here are the results. I did this starting in a trade in December of 11, going up through last year. Okay, we haven't had another signal since getting out there going the other way. But I want to show you, the one I just showed you, of course, was this little bit of a loss that we put on March 13th, and then when we rolled it over, we got out for, with that yield grab there. Not too bad. But you can see here that when the losses occur, they're in general, they're kind of lower than what the typical win could be. Now a lot of it depends what time, how many days are left and all that stuff, and the implied volatility levels. Clearly we understand also these are all hypothetical returns. I did this all in BackTrader using OptionVue's BackTrader. And let's see here. So, and here are the other real statistics on this. Right here we go. Now I'm going to show you two results. One using this system, and the one I used last time I talked to you, where I used 2 standard deviation lines. Here we're selling these 1 standard deviation away with the yield grab. Okay, 64% were 7 and 4, 7 winners, 4 losers. The other notable thing here, the average winning trade was 1881. The average loser was at 1052. Pretty good. When you have that kind of a ratio and something over 50%, you have a good tradable edge there. And let's go and take a look at the 2 standard deviation. Okay, let me show you that one. If we went farther out and let it go to expiration, okay, our average winning trade, because we're going farther out and not getting as much credit, goes down. The average losing trade is down a little bit, but now, there was that one winner. This one had one extra winner because it was farther away, farther out, and that was the one I showed you. We had that little bitty loss that in this one was a winner, so hence why it's 8 and 3 instead of 7 and 4. Here's the most important statistic here. Look at this. If you're letting it go to expiration, The average winning trade length was 38 days. Some months we had, you're putting it on at different times, but the average, if you're letting it go to expiration, you're taking up a lot of time there. Okay, now the average losing trade length was 12. Now look at this. When we go back, look at this, 20 days. The yield grab is shaving off. Okay, now going from a 2 to a 1 line and taking the yield grab, we're shaving off a significant amount of time putting our money at risk in the markets. And that's what's huge here. And I think a yield grab is something that you definitely should apply. We apply it in our Discover Options, in our strategies. We believe in that. Even though we do baseline testing with expiration stuff like you see here, in practice, all our mentors teach the yield grab principles, and you're seeing it kind of played out here, and seeing it statistically work out real well. Anything else we see here? This is let's see, average win, average loss. I'm just looking at some other. Another key thing here. Do you see this number, average win to average loss? Using the 1 standard deviation line with the yield grab, 1.79. Our average winner is significantly higher than our average loser right here. Okay, let's go to the 2. The 2 line, selling farther away and going to expiration, our average win to average loss goes way down. So we have more time in the market. Our average win is less. So I think you could see by going closer in and having a yield grab, certainly your edge goes up significantly here. All right. That is it. I think that was it. Let me go. Yep, there's the thank you thing. Anyone have any questions here? Or maybe I'll do my best to answer questions. I'm looking at the moderated chat area here. And, oh, there I clicked. Okay. Now I see some comments. Sound quality from Peter commenting. Let's see. Oh, good. The email that went out had links to part 1 and 2. That's great. Thank you, Jim. Let's see. Bill is asking, with a bull spread, the bull put spread, if the price falls quickly to a point close to the bottom line, are you happy with a large unrealized loss, hoping it will come back? Absolutely. Absolutely, Bill. We're waiting for price to actually close on the other side of the opposite 1 standard deviation line. That's what we're waiting for. Okay? And so if it does come down close to the line but doesn't close, absolutely, we're going to let it go. And I think you saw earlier how price actually scraped really close to that opposite line without closing on the other side. I'm not going to make any claim that there's some mystical, magical vibration going on out there. Some folks like to talk about that stuff. I don't, but nevertheless, you got to draw a line in the sand somewhere, and often it's going to scrape along that line in the sand, but not come over. And so absolutely, you can deal with unrealized losses, and that's part of the, now for those of you folks thinking about doing this, you do have to evaluate your own psyche here. Because if you're putting on a credit spread, if you're the one that sells premium, and your trading rules allow for the price to come down towards the line in the sand, not go over it, well then you're going to have to deal with some unrealized losses sitting there. The whole thing makes me remember this great film. It was called The Scarlet and the Black. Gregory Peck. He plays this Monsignor at the Vatican during World War II. And the Germans, and he was helping out, oppressed people and all that. and the Germans didn't like him, and so they confined him to the Vatican, saying, if you leave the Vatican, we'll shoot you. So this guy would walk out to the border of the Vatican, and the Germans put this big painted line at the border of the Vatican, in Vatican Square, saying you can't cross this thing. And Gregory Peck would go over there, and he would wave his foot over the line, but not step over it, you know. And the sniper is just watching and waiting. It's all kind of dramatic, and it was a great film. I'd recommend it. Christopher Plummer played the Nazi general. Great ending, phenomenal ending, great moral lesson and all that. Scarlet and the Black is the name. Anyway, so you have to be willing to let price come down, wave its foot over the line, and you don't pull the trigger and get out. See that? And that's trading for you. You have your rules, you have your line, and you got to know price is sometimes going to immediately run to that line like your little 2-year-old, like my eldest used to do. He'd run to the light socket, put his finger an inch away from the light socket and look at me and say, you know, you can do anything about this? And then he would barely touch it, and then I'd go get him, you know, and make sure he understood he wasn't supposed to touch the light socket, right? You got to be that way with price. Have your rules, test them, have confidence, and go on. Okay, let's see what else we got. Will you use weeklies 21 days out? Marty, I think that's an okay idea. Just make sure you check the open interest on those weeklies. Depends what underlying asset you're using, but I see no problem using weeklies that are 21 days out and using those. But check out the open interest. Make sure that they're good and liquid, as most of those weeklies are. But also model the weekly that might be 22 days out with the monthly that might be, you know, 28 days out or 29 days out, something like that. Model the two to see what your yield is and be satisfied depending on which one you take, okay? Let's see here. Which other one? Which vehicles would you suggest? Only indices or stocks too? Saeed, I would recommend, you know, ETFs and indices primarily for this. If you get into stocks, make sure you understand where you are in relation to earnings coming out and how much earnings can impact you know, that underlying stock. At the mentoring program, we have a great tool that tells you how far stocks have gapped at every earnings going back a few years, to about 3 years or so. The percentage of the gap that's occurred, that's a tool for our mentoring students. It's awesome if you trade stocks. But other than that, you could do stocks, but just understand earnings. And Marty, quarterlies could be thrown into the mix too, certainly. Again, check open interest and model the closer option contract months as well. Alan, about earnings moves. At Discover Options, for our mentoring students, we have something called the Stock Analysis Report. And in that report, we tell you how far a stock has moved for each of the last several earnings. Because at earnings, a gap. And in the world of options trading, gaps can be either very good or very bad, depending on, you know, the position you have. But gaps are going to make option prices move dramatically. You think the stock moves dramatically at earnings? I'll tell you what, the options, being a derivative and using leverage, the option prices fly around huge at earnings. And if you're going to trade stocks or stock options during earnings periods, you've got to model properly how much money you could make or lose, assuming that a gap occurs. Now let me ask you, when a stock has earnings, what's the typical gap? Well, depends on the stock. We looked at one the other day. I mean, the average gap had to have been 20% or more on earnings for the last few years. Crazy. Okay, but if you go to a blue chip, doesn't move much, you know, you're looking at 0.5% or less on some of those. So, but you have to be aware of what the gaps can be. That's what I'm saying there, okay? Let's see. Ted is asking about weeklies, typical weeklies opening the Thursday before. No, Ted, there are some assets now that there are multiple weeklies being rolled out ahead of time, and they time them such that between the various weeklies and quarterlies and monthlies have the front 4 weeks trading. They're rolling these out at different times. Now, it just depends what asset, and this is a small group. Well, small. There's a good. It's getting more sizable all the time, but they're rolling weeklies out farther out in time than just the previous Thursday on certain stocks or certain ETFs and stocks. Okay. I know Jim Graham is listening, and he has that list, and we have that. It's all coded into OptionVue which ones those are, and we're on top of the ones that they keep adding to that list. But there's several that you can trade weeklies, this week's, next week, options expiring this week, options expiring next week, options expiring 3 weeks from now, and so on. The CBOE is real good about finding niche markets like this. There's a demand for this kind of stuff for any time frame in the near month. It's pretty phenomenal. Jim just posted that list. Now, let me see here. Can you guys see that? I want to make sure you guys can see that. This is where I look. Okay, good. So let me grab that. Can I grab that? Settings, global. Let me see. I'm trying to grab it and then accept. I'm going to accept that. Maybe you guys can see that. Hope you can. Good. All right, let's see from David. Someone new to credit spreads. Great, Jim can see it. Okay, so I accepted it. Hopefully everyone can see Jim's link. It says William Graham. All right, from David. You're new to credit spreads. How do you provide the training or tutorials to this strategy to gain confidence? David, we have I would suggest that you look at our mentoring program, particularly level 3. We get into directional spread trading, and we give several credit spread systems similar to this one in the context of ETFs and stocks. And we ask all our students to do homework and use BackTrader and test things out before you have your mentoring session. So call our office and talk to them about the class that we offer, in that regard. Several different credit spread systems that we like to talk about here. Yeah, Alan's making a good point here. Let me just hit that. Not a lot of trades, 11 trades over, not 8 years. No, Alan, that's 11 trades over 1 year. It averages out to about 1 a month over the last year. And Alan, I have it than just the one I did here, just to quickly show the premise of the system, how this little one had an edge. Yeah, Doug is saying LinkedIn moved 20% at earnings. Absolutely. But Alan, yeah, no, it wasn't 8 years. It was, and I know you're seeing up here 8 years. I did that, and I thought about changing that. No, if you go back, you can kind of see the here. You can kind of see our first trade was on 12/6/11 down to here. 12/14/12. I just wanted to capture make sure I didn't mess up and not include this range of dates. So I always keep it out to the max. But yeah, that was my fault, my bad, as my kids like to say. Hokey dokey. I think that's about it. All right, folks. Any questions on our mentoring program? Any interest at all? We can always customize a program for you. Maybe like what David here, we can just customize it only for certain spreads. But we have an array of courses we'd love to talk to you about if you're in the market for education. Give us a call. Love to explore that with you. Thanks for joining me on this Monday. Next Monday, there'll be one of our other mentors here. Same bat time, same bat channel. Talk to you later. Take care. Bye-bye.